Back in 2007, Amit Bakshi left his job from Ahmedabad-based Entus Pharmaceuticals due to disagreements with the company's management. After that, he went on to start his own pharmaceutical company, naming it Eris Lifesciences, with an initial investment of just rupees 1.50 crores. He started by marketing specialized medications in fields he was familiar with, that is, cardiology and diabetology. Even though the company had big pharmaceutical companies as their competitors, Eris Lifesciences has grown rapidly and it climbed to the 22nd top pharma company in India within a short span of time. Eris Lifesciences had its IPO on June 16, 2017 with a price range of Rs 600 to 603 per share and later got listed at a premium price of 611. In this video, we will take a look at how Amit Bakshi, who is the current chairman and managing director of Eris Lifesciences, achieved his success with his company in just 14 years and the strategies that he used to create a demand for his company's product in the market to compete with big giants in the pharmaceutical industry. Most importantly, as an investor, we will also look at the future growth opportunities, key risks, as well as financials and decide whether you should invest in this company or not. Now, let's look at the business strategy of the company in order to understand what made it different from other companies in the segment. Eris developed 7 sales divisions to enhance its marketing and distribution capabilities, with each having its own marketing strategy to which treatment areas and brands got allocated. Over the years, this targeted marketing strategy has helped them to achieve significant revenue growth. Eris concentrates on sales in metro cities and Class 1 towns where prescriptions will be highest, and not only that, but by catering to lifestyle related disorders, Eris generates 62% of revenue from high growth chronic segments including cardiology and diabetes. The company recorded more than twofold increase in the segment, that is of chronic segment, with 26% CAGR in cardiovascular treatment and a 35% CAGR in anti-diabetics. In terms of manufacturing, Eris has a manufacturing facility in Guwahati, Assam that complies with Indian regulatory standards, and it also outsources some of the production to other toll manufacturers in India. Among the management, Mr. Amit Bakshi, who is the current chairman and MD of Eris Lifesciences, has more than 20 years of experience in the pharmaceutical industry, and he has been recognized as an Entrepreneur of the Year in 2013 by Ernst & Young. Under his leadership, Eris has acquired Strides Shasun for Rs 500 crore in order to expand its business into central nervous system category. Let's look at the key strength of this company. Eris has a product range primarily focusing on therapeutic areas requiring the intervention of specialists and super specialists such as cardiologists, diabetologists, etc. Its business model is of building strong and sustainable brands, and thus it has enabled the company to not only maintain but also expand market share. Apart from its leading brands, the company has a deep-rooted network of medical representatives which are constantly serving the doctors. The company has huge growth opportunity because it only has a 0.7% market share of IPM as of March 2017, and following the Strides acquisition, Eris has risen to the ranks of the top 25 companies in Indian pharmaceutical market with a market share of more than 1%. Eris went on to increase its doctor base to 50,282, that is 50.7% of doctors in India's metro cities or Class 1 towns in financial year 2017. In fact, this doctor base was only at 24,606, that is 9% during the financial year of 2012. In addition to this, the company increased its share of prescriptions in metro cities and Class 1 towns to 1.3% in financial year 2017, which was up from 0.9% in financial year 2012. Future growth opportunities. India has a population of 1.3 billion people. Out of that, 77.1 million are over the age of 65. Increased life expectancy implies a larger potential for Indian pharmaceutical market. Also, overall healthcare spending in India is expected to rise as a result of country's high real GDP growth rate, rising GDP per capita, rising affordability and improved healthcare infrastructure. As the existence of chronic diseases has increased due to an increase in lifestyle disorders, the chronic category's share of Indian pharmaceutical market has continued to rise from 31% in financial year 2012 to 33% in financial year 2016. Now let's look at the key risks that the company may face in the future. The Indian pharmaceutical market is heavily regulated, and any failure to comply with the applicable regulations prescribed by the central, the state, and the regulatory governments, as well as any failures to obtain or renew any licenses and permit, could have a negative impact on the business. The pharma industry is highly competitive with the big players, so if the company is unable to adequately respond to increased competition, it may lose market share and profits, which may end up having a negative impact on its business, the results of operation, and financial conditions as well. The top mother brand groups account for a sizable portion of the company's revenue. As a result, any brand group's loss of market share may have a significant impact on its sales and profitability. Peer comparison. If we are to compare the product range of Eris with its competitors, we can say that 98% of the products are in the growth stage and mature stage, whereas the product range of the competitors are not even close. Greater proportion of the product is in the growth life cycle of the company as compared to the IPM. This gives a significant advantage to the company as it seeks to grow the prescription of its products in the future. Let's take a look at the company's financials to understand how the company has been performing throughout these years. If we are to look at the sales of this company, we can see that it is on a continuously rising trend since 2015. In fact, from having a sales revenue of only 546 crores in 2015, it has gone up to 1212 crores in 2021. When it comes to the operating profit of the business, we can see that even that was also in a continuous uptrend. And this shows us the efficiency of the business and how it has been able to control the cost during these years. Due to this, the profit after tax has also been increasing throughout the years. From just having a profit of 55 crore, we can see that it has increased now all the way up to 394 crores. If we look at the balance sheet, we can see that the reserves of the company has been increasing throughout the time and it has almost zero borrowings. Also, the fixed assets of this company has been increasing, which shows that it is reinvesting the profits into acquisition of various businesses and assets in order to grow its business further. Overall, the financials and the balance sheet of the company is very strong, and considering the trend, it is expected to perform well in the future. If we are to look at the shareholding pattern of this company, we can see that the promoters hold a majority of the stake in the company at 52.7%, and this is a positive sign. Also, FIS and DIS holds 13.6% and 9.9% respectively. That is, the public holds a 23.8% share in the company. Now we will try to take a look at the charts of Eris Lifesciences so that you will understand what is the behavior of the price. So if you look here, after being listed in the IPO times, it tried to break out from that level. However, that failed. So this became an important area, and if you look closely, you'll be able to understand that this important area has been broken and got retested. That is, after breaking out from this area, it retested this and tried to rebound from there, which means the current important area is this, indicating that there is some sort of selling pressure coming over there. Now, the most important thing is that if you are to take an entry now, you should keep your stop loss around this zone so that you are not losing out any huge portion of your capital. Otherwise, if you are to take an entry safely, you can wait for this area to be broken. That is, after this get broken, it will come again for a retest, that is a pullback. And when that happens, you can take a safe entry over there and ride the trend with moving average or either with any of the exponential moving average. So your goal would be rather to wait for the area to be broken and then retested, and you should wait for the big up move so that you can take a good entry in it. However, as an investor, if you are still planning to go along without bothering about the way price is behaving, you can take an entry at this current levels because it is still looking safe. And as you can see, this area is a very incredible strong support considering how it started ever since the listing time, that is around the July of 17th. And of course, keep in mind that when this area is broken, it will be a multi-year breakout, making sure that there will be a strong momentum coming in, and there is high probability that it will be an explosive big up move. In this video, we understood the business of this company and its financials. Also, we have gone through the chart so that you have a clear idea on where to enter into this stock if you are a short-term or a long-term investor. I hope you enjoyed this video. You can get more updates like these on our Telegram channel, which you can join by clicking on the link in the description. Also, please like and subscribe to our YouTube channel as that would be helpful for the channel. If you have any suggestions for us, don't forget to leave it in the comment section. As always, we will see you guys on the next video. Bye bye and take care.